Okay, Dwayne, you haven't missed anything. We're just beginning. So I'm Tim Quast. This is the November 10th live demo, and we will commence here. So the first thing on my list is this topic, Barry. That we were Barry Norton, that we're talking about. That the market surged. And Steve, you mentioned the bond market moved violently right as the inflation data came out. And so what does that mean? Well, it certainly means that people are using derivatives to bet directionally. Then that becomes an input into the stock market where stuff does not move the same. You probably noticed that there were stocks here. I'll share my screen and just give you one illustration here. And it's a stock that we have seen in the data has appeal for trading. I mentioned it in the couple of times in the last week or so. I traded it, and that's Sunrun. So stocks like this, which okay, that's a good supply demand divergence. If you're new to Edge, this is 10. It's hitting 10. It didn't just arrive there. It's been there for several days. And here's the supply side. There's that supply deficit relative to trend. Now, this is an extreme case, but it tells us, the machines like Citadel and Virtu and Hudson River Trading and Quant Lab and Infinium and Tower Research and so on that are consuming all of the data are going to have a pretty good idea what kind of collateral resides behind the futures contracts that are tied to how the market moves. The futures contracts they're just a proxy, but the parties that are going to be long or short those are the ones that will have to step into the market, and that's how the Dow goes up 1,000 points. That's not the result of people saying, well, inflation has come down 15% or the pace of it, so let's buy everything. That's not how it works. So machines are going to be able to sort out that stuff like Sunrun could move violently, and of course we have some idea of that by looking at volatility, not the kind that you see in this sort of instance, but you could. I wanted to cover volatility today too, so I'm kind of mixing it in. But it's a great example. This is just an ideal example to me of what I mean here. So here is Sunrun, and it moves on average 10%. That doesn't mean it happens every day, but somewhere intraday on average, if you were to perfectly peg the high point and low point, they would be separated by almost 10%. Well, you're not going to be able to do that, but you can capture a good part of that. Well, did you look at Sunrun today? It's just, sorry, let me see here. Here we are. That, go here. Here's what I want. Okay, so here is, let's see, run. I want to look at Boeing too a bit later, but it's up like 26%. Is that normal? And how would you capture that? Well, you can't. And I don't feel like you have to chase that. I don't have to tell you veteran traders, but don't feel like you have to chase that, and B, trying to capture it is a fool's errand unless you just follow the data. And I would say in these situations, which are not rational, I don't know what's going to happen next. I don't know. We know what sentiment is doing. We know what the supply-demand equation is. I know what tends to occur around readings of this sort. We can look at the whole data set. But I know when these kinds of situations occur that the principal driver will be people winning and losing on derivatives. And there will be a consequence to that. I don't know what it will be. But could you have known that this would move like this? Of course not. But if you were if I look at this sort that I did, which I'm still testing, I have not, and we have not in the data found the perfect solution. I feel pretty good about our momentum sorts and the kind of sort to do when the market doesn't have very interesting that the data don't show us a lot of opportunity. So this thing that I call alpha, this is the criteria in this. I'll show you what the criteria are, and you can test this too. I mean, I don't think it's perfect. I'll show you what I do with it, but if you want to screenshot this, and there it is. So what I try to do is find demand greater than 8. So I'm the thing, even before they get to 10, the 5-day trend is down in short volume, and it's less than 50%. Dollars per trade greater than 3,000, because that number keeps shrinking. That keeps me in the top 1,000 most liquid stocks. I put a volume figure in there too, just to narrow the field a little bit, of 750,000 shares or more. Volatility, that's that intraday move of more than 3% or more. You might as well, if you're going to trade stuff, find stuff that will give you some return. There are times when I'm not going to do that, but that's what that's aiming at. And then market structure, sentiment trend, not equal to down. I mean, it could be sideways, but I don't want it down. It could be topped, could be bottomed between 8 and 10. But I just want to find this group. And I've screened out small caps. That doesn't mean small caps are bad. You can trade them. But for me, the risk of getting into and out of them isn't worth the reward. And I think a lot of big institutions do the same thing. It's not a lot of the market anymore. So that's the criteria. And then when I look at this, and again, if feel confident that these things are going to be helpful to you, we will put it on the platform. Right now, to me, it gives me too many things. So I look at it and then I hit demand so that I sort it by demand. And it will give me, it'll sort it from 10 and the lowest level of short volume. That's the default. And so then I can look at those and say, well, there's probably a pretty good chance that this stuff has some opportunity. And if you took the top 10 and looked at how they did today, all of them are up, of course, but actually Gilead might not be. And LPLA is not up because they did a deal. That events affect outcomes, but the rest are up. Are they up dramatically? Some of them are, some of them aren't. Run is. Wind did pretty well today. A number of these did, but could we perfectly find the stuff that'll move on a day like today when derivatives, when bets are driving the market? No, and that's okay. You know what matters isn't whether we catch a 1,000-point move in the Dow, but whether we are consistently capturing gains, and it certainly has been working well. So I hope it has for me. Hope it has been for you too. So that's where, there was a couple of other things that I wanted to note about this, that today there was an explosion of volatility halts, not like we saw in March of 2020, but maybe the biggest number in quite a while. And what that tells us, so volatility halts, here's a little market structure lesson for you again, but there are girders in the market that are designed to keep stocks from moving more than 10% from their reference price in 5 minutes. So if that happens, then that stock will be automatically halted for a few minutes. I think it's 5 minutes, and then it will resume. And if it happens again, then it's halted for, I forget, longer. And if it happens again, then it's halted for the day. But there were a lot of those today. That again that's the tail wagging the dog. That is the effect of derivatives. And we'll see the most volatile small elements of that. I liken it to spackle splattering on the wall. You get a read of what's occurring, and there was no central theme to it. Sometimes we'll see, oh, it's all in tech or it's all in healthcare. I didn't notice that today. And is that a big deal? No, it's just an anecdotal thing, but it's how the market works. And it goes back to volatility. Volatility is a big deal. And being able to use it to your advantage is an important part of that puzzle. Okay, so if I look at the finishing this discussion about what the market's doing, this is broad market sentiment, and this is what Barry was talking about. There's relative to the trend, back here when the market was coming down, look at the supply. We hit a 53% in here one day. It was averaging about 52%, maybe it was a couple of days. And so here's the price of SPY coming down when demand rose, even against that huge supply. It stopped the descent of the market for a bit, but it's too much. This is right at options expirations, right at index rebalances. So here's where it is now. So that clearly has contributed to some strength in the market, but it is, at 48%. Should the market move like, should the Nasdaq be up 5-6%? Well, of course not. Again, these conditions to me say not that the market will tip over, but that it's probable that it will begin a slow decline. And so to have something like this tells me that it's outside the data. If the data don't show this, then we know it's occurring in derivatives. Just keeps reinforcing that point. If I look at big and stable, and there are 3 in it, well, I know that it's not a big and stable market. That's not the place to go for returns. And if I look at momentum as we're sorting it over here, 2 in it, well, it's not even a momentum market. So this is don't think that this portends a bunch of momentum. If the data change, fine, we'll just adapt to the data. I'm not making a pronouncement about the market. I'm just looking at the data, and the data, they were correct about the outcome of the election. The data did not show a big surge for stocks with the election, and there wasn't. This is a big surge for stocks on inflation data tied to derivatives contracts, and derivatives tend to be, I should add, it's a one-time event. It is not investment. It is squaring wins and losses. And then people have to back away and figure out what they're going to do next. And that could have big bearing on options expirations next week, because people will have lost money. Banks, people who bet the wrong direction, they will have paid a big price, like in the crypto market. Man, what a mess that is. Volatile 10s, just 1. So unless that data gives us a whole bunch of opportunities, I am suspicious. And that should lead you to very quickly take gains. Speaking of which, that leads me to the next point. And interrupt me at any time, as you know, just to fire away if you have questions. But I want to talk
Tim,
a little bit about, yes, Barry.
Back on your alpha.
Or Steve, sorry.
What your
yes.
Screener was set up for.
Yes.
I can just throw one other idea in for you that has really helped me, is that I run 2 screens now. I run one with your new short 5-day and one with your short 1-day, because you can be short on your 5-day and the last 3 days even could be up if you're had a large drop before. So I'm running both of them, and then I see what's in them and what falls into both of those.
It's excellent input. I actually do something very similar. I have 2, and I think this one does that. Yeah, see, I'm only finding 1 in that sort at the moment, but it is looking specifically for that 1-day downtrend that you're talking about. Yep. Right. You're absolutely right about that. There's no question that the math supports that works.
Okay.
So back to this. So I want to show you a couple of things in here about moving to this point about exiting. Combining all of this. Can we predict a day like today? No. Can we trade things during it? Yes, with the same data, following the same thing, diverging supply and demand. And I've got a whole list here I could look at. But how about exiting? I already had sold my Nike, so it did very well. Why did I sell it? Well, simply because the trends, the demand side was falling. This does not indicate that Nike's going to decline. Because look at the supply side. It's falling too. And demand is still above 5. The whole time that it spends above 5, there will be a propensity for it to rise, all other things being equal. If there are blips on the supply side, then the price will drop. They're highly correlated. We see that all the time in earnings. Here, this little dip right here led to that. Very nice jump for the stock. Well, that we can use that, and it's exactly what Steve just pointed out. If demand is rising and all of a sudden supply drops, well, there's a very high probability that will dislocate the price, right? If the same behavior arrives today that arrived yesterday and there's less supply, the price is going to move. It's that simple. But how would you know when to exit? Well, here's the other side of the coin again, bringing volatility back. Just looking at this in a portfolio, I had mentioned it on Monday on Benzinga. So here's what I look at: 3.5%. Well, I think it's up 5% today. So if it's up 5% today, you could say, well, maybe I'll get another 5% tomorrow. It's exceeded its volatility. That increases the odds that it's down tomorrow. I'm not saying it will be. I'm just saying that the machines that calibrate these prices and that take advantage of volatility, machines create the prices. And they're using models to figure out where they're going to take the other side of somebody else's trade. And so that's probable. Doesn't mean it'll happen, but it's a great reason if you're in Nike yet that you should take gains, right? It's that simple. You can always buy it again. If it dips and the data are just as good, by that decline, if it goes down half of the intraday volatility, it's a very good opportunity. And that's what I did with Sunrun. When it dropped, it's a major part of its intraday volatility. I bought it and I made a significant return that way. Does that all make sense? I hope. Okay. Let's see. I want to go back to and fire questions away. I just want to look at a number of these stocks. That was a principal thing I wanted to cover here.
Hi, Tim.
Yes.
Can you explain how some of the stocks I've come across with the short supply of like 3%? Why shouldn't you just go all in on a stock like that?
That's it. And they're probably very illiquid. Do you have an example that we could look at?
Is it THRX, the pharmaceutical one? It's been running for the last couple of days.
Okay.
One of them.
Okay. Let me. In fact, I'll look for it in a portfolio. That might be the best thing to do here. Logically, in healthcare. Okay, so let me pull that up. And so here, here's the reason. So if you look at the stock and it's 15% short volume, and probably below that at certain times, all the way near zero. And what does that mean? I mean, could that stock move? Well, sure, it could, no question, and it has. There's no doubt that you can get returns on the same principle, diverging supply and demand. The challenge is going to be the light liquidity. It's got some. It trades, and you probably sorted for that. It trades $3,500 at a time, which is a pretty big trade size for a stock that is priced at $6. But the market cap is 250 million. It trades 24,000 shares a day. So if you have any kind of size, it's very difficult to get out of that. So that's my answer. Could you do that? Yeah, you could probably corner the market in that stock, but can you get out of it? That's the trouble, that's the challenge with stocks like this. I like to trade the rate of petroleum. But it's got the same issue. It's a stock that can produce enormous gains, but it's difficult to get in and out of. And it trades at least $3,000 per trade, because I will trade stocks like that. But the fact that there's a big spread between the bid and the offer can mean it's challenging to get in and out of. So that's the cautionary note. Could you just go find those? Well, I think there's a certain level of short volume that is necessary for the market to work. And sometimes seeing stuff at 5-10% just isn't enough. So a long-winded answer to your question. It's a very good question.
Yeah, that's brilliant. Thank you.
Tim, can you show the scan for your alpha too? I want to get a feel for what Steve Hicks was talking about.
Okay, sure.
I'm just listening to a thing on that market structure edge I'm trying out.
I'm glad that you are. So here it is, Barry. Let's see. So here's the short volume 1-day trend. That's what Steve's talking about.
Okay,
that's the key.
Cool.
Yep.
Cool. Thank you.
You bet. it's been very effective. Good question. I wanted to point out, if you were going to try, this ties in with my earlier comments. Well, how do you capture moves on a day like today? Just trade the stuff that we already know works.
That guy,
like this. Hey guys, don't forget to mute yourselves.
You get an automatic reply that he's out till November 15th.
See if I can mute this first. Here we are.
Well, I looked at one.
There we go. Okay, sorry about that, guys. Okay, so like you can say, here's a great example. If Ford and GM were both in great sorts here recently as things with very strong demand. It was right there, and then supply started to come down. That divergence created a lot of opportunity. And this stock, I would be, if today, if I were in, I don't own Ford, I would be leaving it today. For that reason, you could probably look at volatility and say, well, it's exceeded its volatility too. It could continue to run. Once again, stocks that are above 5 with declining supply tend to do well. You could build a long-term portfolio that way. You could take a 20 stock sample of the S&P 500 and rebalance it to make sure they all are always over 5. As soon as something drops below 5, replace it with something else. You could do that, and you're probably going to outperform the broad measure, simply because you're choosing stocks that have better demand than the whole thing put together. I mean, just an idea. But rather than going to try to say, oh, I should go buy a three times levered product to capture this huge gain in the market, it's better to just trade stuff like this. You can still capture the moves in the market, and you will know when to go. Right there, there's this uptick is telling us that probably if you get the full volatility move of that stock, then leave it today. Let's see, is this in? Where is that? I want to look. It's given me everything because there is still this issue with that sort. But I know where it is. It's going to be in consumer discretionary, I believe. Right? Am I right? You experts? I think so. So just do this really quick. Maybe I'm wrong. Maybe it's in industrials. Well, anyway, I'm wasting time. I just wanted to point that out. That's a very effective way to capture gains in a market that's moving. These stocks didn't jump like the broad measures instantly. When the market opened, the Dow was already up close to 800 points almost. But these stocks kind of gradually built there, so they could work pretty well. But you should take the gains, right? But take when the volatility, when you achieve whatever the volatility read in that stock is, it's time to go. Even here, I wanted to point this out because while demand is coming down and supply has bottomed and ticked up, it's still above 5, still something that in this kind of market, you could, if you were in it already, that you could produce gains. But if it went up its intraday volatility, there's a reason to leave. That's the key point. Let's see. I think Boeing was another example like this that I wanted to point out. All of this relating to putting everything together. Great demand. If you're in Boeing today, which I think is up 6%, just hit 10, and you would see this before the open. So if you're in it, you would know, well, I'm going to look. Probably if Boeing is up today, it will be a good reason for me to leave because supply jumped above trend. Well, it consumed all of its intraday volatility. Could the stock continue to rise? Of course. I mean, tomorrow we might see demand at 10 for a second day and that this has gone down. But take your gains and go find something else that's got better math. But this kind of situation puts all of these things together to help you know what to consume and when to leave it. And I think that it's pretty clear that way. Okay, I'm getting near to the end of the things that I wanted to talk about. Questions? What you got? Or examples?
Hey, Tim,
yeah.
Jerry Morris here.
Gary.
Would you look at Dollar General? Interesting
Sure.
day yesterday, way down, and came back up nicely today.
G, is that what that is? I can't, yes. Okay. Yeah, okay, well, you're still above 5, but once demand weakens, even though supply, that's still helping you. That's still helping you, no question. Let's go look at it in the portfolio. So, and I don't know what it's doing today. Is it up or down today? Gee, I think that's in consumer discretionary. Gary, is it up or down today?
It's up, what is it? It's up over, I gotta take my glasses off and look at this, $9.
Okay, so
Almost 4%.
okay, here we go. So looking at that data, let's look at it both ways here. So it's another very good illustration. It moves 2.5% on average between intraday high and low on a given day. Once again, it may not do that every day. That's taking I think it's a 5-day average. So if it's up 4%, 5% today, and you have falling demand, even though the supply side is fine, I would be very inclined to take the gains. Now, it may revert to 5. It spends a lot of time at 5. There's no question. It is what I would call a big and stable stock, a stock that tends to do well in more challenging markets and maybe less well in momentum markets. But I would be inclined, because that's a gift. I mean, you're getting twice the total mathematical return that a machine would expect in Dollar General. So that's how I think about it.
I got into it a little after 9:40 when it popped back up, and
Okay.
I was out of it before noon, made some nice money. So thank you.
Good for you. You're on it. You're doing exactly right. Yeah, that's good. Okay, what else you got? I'm actually, I mean, other than this big list of tickers that I could look at, I've consumed my I had 4 today. Just had 4 things I wanted to cover. What else? Anything about how is there something that you're doing that you want to share with the group? Please do so, because that's a great part of this group getting together.
Can you go back and do the volatility going up? I always work with volatility going down, not
Okay.
up. If you could just review that one more time on when the volatility is rising rather than, or when the stock price is rising versus when it's falling. Assuming I'm not going to be a short buyer.
Okay, yeah, I would like to be too. I feel like I'm missing out on half of the opportunity to generate returns by not shorting, but I haven't spent the time to become good at it. So, for instance, here's I was if one were going to buy Sunrun, and we're talking about volatility, and I say I like to buy stocks that I think have good supply-demand divergence when they're down, because I think that in the next 3 days, I'm very likely to produce the return. On a day like today, where the market is just out of control, if the stock doesn't move much in the first little bit, well, there may be an opportunity, and I'm not sure I'm answering your question, Steve, but that to me is on a day when the whole market surges, and you think, well, the supply-demand equation is good in Sunrun. It could go up 10%, and it hasn't moved with the market. There may be an opportunity. Otherwise, I much prefer. I think we'll see what Gilead's doing. This, Gilead is down a little bit. What was so here? Could Gilead do well tomorrow, even if the market doesn't? Even if the market were to give back what it gave us today? Probably, because it actually dropped. It's down on a day when everything else is up, and it was down a part of its intraday volatility. Am I answering your question?
Actually, I was thinking about when it's going up, do you use getting out with the volatility when say you've got a volatility of 5%. Yep. If this stock has gone up 5 or 2.5%, because I know you use about 50% usually. So if it's gone up 2.5%, do you bail?
how can I? Maybe, yeah. That's a. I'm equivocating because I didn't sell Halliburton today. It was up 3%, but it moves about 3.7%. So I thought, since the supply demand balance is still good and the dollar is down, not that I factor that in per se, but oil is up and the dollar is down and the supply demand balance is good in Halliburton, and we're seeing these footprints other places like ConocoPhillips shows up in a sort, and there were a number of others that, as good as energy has done, that it may do well. So that's why I equivocate on that answer. I could have just taken the 3% in Halliburton today, but I decided I think it could give me more. So that is a subjective. That's a game time call. Generally, yes. If a stock has 5% volatility and it goes up 3%. I'm probably going to take that because a 3% return with a large enough position is really good. And I like to repeat that.
So Tim, I've got a good example for you for what Steve is asking. So Steve was the one that first coined, stocks you put out have a good return when you put them in the morning email. So on Monday, you talked about AR.
Yes.
And you talked about it in Benzinga. Okay.
Yes. That
baby shot
Perfect.
up. Shot up just over its volatility move that you identified.
Yep.
I got out. You come in the next day, it dropped by that volatility move. I got in and got out.
Perfect.
And then when I got out, you can see what it did. So it was a nice 2-day run there. Monday up, Tuesday went down, then went up, where I played the volatility as a function of it first getting to that level and then dropping that level and then getting out. So it was an interesting example.
That is exactly. There you go. Okay, that's exact. And what a great. Had I been paying attention to this morning, I would have bought Antero this morning, particularly on a drop, right? That it drops, and the whole market's up, and of course, energy wasn't to begin. But it's inevitable that when futures contracts cause something, that it will likely ripple through areas of the market that have moved a lot. People will have exposure to that. That will be collateral. What I mean is, if you're buying or selling volatility, you're going to hold some assets that are related to that. And if the price moves dramatically and you're holding the asset, you're going to have to increase your exposure. And that's what banks and their customers do, and that's what causes the stock market to go up 1,000 points. But wow, that's a great example. And if you're still in Antero, leave. It's a good right. Take that game.
Might add to that that at least in the way that I work, when I see it going down and it's hitting that point where I want to buy into it because of the volatility, I'm going to be looking on Benzinga to see that there's no hot news on it.
That's a very good point. That is a very good point. And I always check to see whether it comes, particularly right now, right? We're getting toward the tail end of it, but it's earnings season. So, we'll here, let me do that again. So I always check for that too, right? I'm always going to check because you can get caught out, and you want to eliminate the as many risks as you possibly can. There's Antero. So you'd say, well, it's not hitting 10. I mean, am I going to buy that? And the supply side is right at the trend. Well, it went back up. It's not perfect. It's not the ideal here and a big, supply deficit, but that's still pretty good. And the more time stocks spend above 5, the better they tend to do. And volatile stocks that are down will give you, there's a very high probability of returns in that. Okay, I've taken you plenty long. Good to see everybody, and we'll do it again next week. We'll be right into options expirations next week, by the way. That could be very interesting. Have a good week. Thanks,
Tim. Appreciate it.
Thanks, Tim.
Bye. Thank you.
Let's see, I won't leave here and forget to turn this off this time. I have done that before. Let's see here.
Hey, Tim.
Yeah, fire away.
Yeah, just one quick one before you go. So I was trying to kind of grasp, kind of the mentality I have on this. You said that like on a day to day, when the stock is just killing it, and yet we have very few opportunities based on the screens, say the volatile tens or whatever you might look at, and that leads you to believe that derivatives are responsible for a lot of the movement. Is that what you said earlier? I think. So how do you change your mindset in using you know, the screens and so forth? Do you put more caution in when you go into some of the picks that are screened? Or I mean, from your standpoint, you have a macro view of how the market works. What does that tell you? How do you change your mindset on investing that day or trading that day, I should say?
Right. Well, I'm going to use diverging supply and demand. And when broad sentiment is falling and supply is rising, I'm not going to put all my money to work. I've got in my little trading account, which I keep around 45,000 thereabouts. It's a little over that right now. I've got 17 in cash, so because of that. Which I might use if there's an opportunity, if the data gives me a very compelling reason. So that's what I do. It does make me more cautious when the broad sentiment indicates higher risk. That's what I'll do. And we'll find out, that the math could change. I'm not making any prognostication about what the market does tomorrow or next week, but generally the math is correct. That if we have a move like this and the math didn't give us a cornucopia of momentum opportunities, there is a high probability we give it back. Again, I'm not saying we'll do that. We'll find out. But in any case, I'm going to stick to the math. If the math says it gives us 15 big and stable, I'm going to use big and stable because the math is telling me that's where the money is. If the math gives me a handful of momentum opportunities, I'll trade them, but not with all my money during these times. That's my approach.
On the dashboard, it'd be kind of cool. I don't know if you could do this sort of thing, but if you could put like a small graph of the last, say, 10 days or whatever, of the amount of entries in each of the portfolios, so you could look at a trend and see, kind of what you've called out many times, where you start to see a drop off in the screens.
So Barry's actually
cool
spot on. Yeah, Barry's actually spot on, Tim, because I do the same thing. I track big and stable, how many stocks are in it. Volatility 10, I track that. So he's right, as an internal metric to be able to see, even over a longer term, how many were in the portfolio based on the screen you have. It's a fair indication of what the data is telling you with regards to the math. Because I do the very same thing.
I'll make note of that and see if there's something we could do.
It may be something where it just helps you to be a little more intuitive of how to, take advantage of your platform even better. So
I know it's challenging. I know it's challenging for doing the layout on the web page, but just to those portfolios that you deem as market indicators, like you've pinged like momentum, big and stable, and volatility 10.
Yeah, I will ponder that. We could well do some kind of gauges, something like that. So I will ponder that with the team and see what we can do. We have another guy now too, another engineer. So that's helpful. Who knows this programming, this platform, Azure Blazor. I'll give it some thought. Which reminds me, Steve Hicks, that you asked about alerts, and I haven't done this yet. I don't use them very often, so I'm gonna have to test to see where they are. I just kind of forget about them because I tend to be in and out so fast. But I have not forgotten about that question you asked, and I'll see what we find out.
I can. There you go.
Oh, there we are. Okay.
Sorry about that. I was just saying, for those of us who have a life beyond sitting in front of a computer, being able to use alerts would just, it would be life changing for a lot of people who are stuck to the screen.
Yep. I totally appreciate that. Yep. Okay. I kept you long. This is good though. Those are good questions. Thank you, guys. All right.
Thank you. All right.
All right.
Tim.
Have a
Thanks for
good
sticking
Friday
around.
tomorrow and
You
weekend.
too.